Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Welcome to Many Happy Returns, where we aim to make you a better investor. I'm Romin.
And I'm Michael.
We're halfway through the year and it's time to take stock. The AI narrative continues to power the equity bull market, central banks have started to cut interest rates, and the US presidential election looms large.
I want to know if things are as good as they look, and what risks lie ahead for the rest of 2024. And in today's dumb question of the week, what isn't priced in? All right, let's get into it. So as we headed into this year, I remember that people were thinking, this is the year we're going to see a lot of rate cuts. I think the market was pricing in around 6 25 basis points cuts for this calendar year. And I think it's fair to say that isn't going to happen. At least it looks very, very unlikely now. The Fed hasn't even done one cut yet.
And the Bank of England too. I think what surprised central banks was how sticky inflation is, particularly services inflation. And also wage growth is surprising on the upside. So these factors combined probably make them more cautious. And the optimism that was priced in at the beginning of the year just failed to materialise. And I think people were expecting that it would be a repeat of 2023, but that hasn't happened. It's been much more choppy.
And yet, equity markets are pricing in loads of optimism still. We're at all-time highs. The AI narrative is continuing apace. Times are good, right? Do these things seem a little bit out of line to you?
I can see the optimism. You look at the rate cuts which are priced in, and I think it's more realistic now, and I think they will cut. And that's obviously good for growth stocks. Growth stocks have responded already, so I think they've already priced in a lot of that optimism. And inflation's falling, and growth is okay across much of the developed world, so that's pretty optimistic.
And companies are doing well. Earnings are good. Margins are good. It's a good time to be an investor, right?
Yeah.
I remember doing this podcast through 2022, and we always joked, where are the many happy returns, right? It's gone wrong. But we're back on course.
Yeah. I think it's a return to the triumph of the optimists, which is always a nice place to be. I always think it's nice to have that optimistic frame of mind. And as an equity investor, I've come to this late in life. Originally I was quite pessimistic and I was a bond investor. And now I've very much come to the frame of mind that it's actually good to have a positive outlook because most of the time things are okay.
I feel like you're a natural pessimist who's had to learn to be optimistic. You're a bear at heart, really.
That's right. And it was data that forced me to change my mind, which I think is something I'm quite proud of, to be able to coach myself, to mentally reprogram myself to be an optimist.
I think for anyone listening to this who is a natural bear, they'll be saying, yeah, there's optimism, but then there's also sort of irrational exuberance. And this looks a bit bubbly. Because if you look at what a lot of analysts were forecasting at the start of the year for, let's say, the S&P 500, they were expecting a kind of normal year of 5 or 6% base ratey growth for stock prices. And we rallied right past that by March, took a little bit of a lull in April, and now the rally's resumed. Is this a bubble? Or are things just good?
Well, you never know until you're well past it, whether it was a bubble or not. And it has to pop in order for it to be a bubble. But are valuations high? Well, yeah, they are high. And that's largely because of some subset of the stocks, which are very important in the US market and in the global market, which are overpriced. And I say that with a fair amount of confidence. You can look at their price and say, yeah, the optimism about future profit growth is just too high, I think. Even if the AI narrative pans out, I just still think that that's too optimistic. And at some point, I think that reality is going to wither what we've seen so far.
Certainly, if you look at the graph of valuations, so let's focus on the price to earnings ratio, the forward price to earnings ratio in the US. If you look at just tech stocks, we're at a P ratio of over 30, and you have to go all the way back to 2002 as the dot-com bubble was popping to see valuations that high for tech stocks. Admittedly, we're a long way short of where that bubble reached, which was over 50 at its peak.
So I describe this as a kind of pseudo bubble. It's not quite fully inflated. And the earnings growth, if you look at Nvidia, for example, is staggering. It is incredible. but the prices have got a little bit ahead of where the earnings growth is.
The thing is, if the bubble's still inflating, I want to ride the bubble right to the top and step off just at the peak.
Yeah, we all want to do that. And timing these things is very tricky. There's usually some kind of earnings result which disappoints, which starts to make it pop.
I'm only joking, of course. I don't think we can time the bubble and get off at the peak. If we want to benefit from the stock returns, we've got to just hold them throughout these ups and downs.
And particularly investing a lot when they've fallen. I think that's a really difficult thing to do.
I mean, I focused on tech stocks there because market concentration looks so high right now. And the American market is actually more concentrated in just a handful of stocks than it was even in the late 90s, early 2000s.
So in a sense, it is a replay of what we saw last year, which is that tech and mega cap tech stocks have been the ones which have done particularly well. So tech is up about 25% year to date so far.
Which is a long way ahead of any other sector. Communication services is not too far behind, but that's kind of pseudo-tech really, isn't it? Things like Google.
Yeah, a lot of the things we'd call tech stocks would be classified as communication services like Google.
So there was a good piece in the FT this morning by Robert Armstrong, and he looked at the last 3 months and the change in market value of the S&P 500 and broke it down into different buckets. So firstly, Nvidia stands out on its own. It's added around 45% to its market cap, which is almost $1 trillion in a quarter, which seems incredible. In fact, so incredible, I've just been Googling it to check that his graph isn't wrong.
And in terms of FTSE 100 units, so if we look at the entire market capitalization of the FTSE 100, that's about 3 trillion. So that's about 0.4 FTSEs that it's added in a quarter.
Yeah, Nvidia's worth more than the FTSE 100. And it's done that in a blink of an eye. So that's clearly the standout success. But then if you look at all the other chip companies, they've gained 17% in market cap. And then if you look at the rest of the big tech companies, they've added 11%. And then if you look at everything else, so everything that isn't Nvidia, a big tech company or a chip manufacturer, they've lost in the aggregate 2% in market cap since the end of March. So there's a massive divide in the market. Like the S&P 500 at the broad level is doing really well, but it's getting more and more concentrated into this one sector and this one theme.
But the US is a very faddy market. It tends to have narratives and then stocks fit in with that narrative. It's not clear what drives what, but there's always a new story. And I think that's one of the great triumphs of the US market, which is it's incredibly good at coming up with narratives.
And investors are willing to back those narratives, right?
Well, what they seem to be able to do is to make them real. They can take an idea, something like a communicator from Star Trek, and yet we have them in our pockets. So, video phones, which I saw as a kid and just thought, oh, that's so cool. I can't believe that'll happen in my lifetime. And yet we all just take it for granted now.
I mean, they do pan out, but not all of them. So we had that big metaverse rally, and that's not real. So maybe it's the fact that they can have loads of themes and just ignore them when they go wrong and move on to the next one.
But that's great. I think not all ideas are good ones, but they can deliver on the ones which really matter. And AI is one of those. What's kind of interesting is that in China as well, we're now seeing companies which are generating movie quality video where it's really difficult to tell it apart from reality. So I think that's going to be the problem. There's eventually going to be other companies which can undercut these American companies. In certain markets, they can dominate. For many years, it was things like chip design, but eventually other countries will be able to compete.
You'd think so, but tech is quite a sticky thing generally. Like it's only really now that Google's dominance in search is starting to be challenged because of AI. They've held a near monopoly for so long. Likewise with Meta in social media. I think on the consumer side of things, like who's going to deliver the AI product that the consumer actually uses, that's a huge battle going on right now. Apple's stock price has done really well in the last few weeks after it announced it was bringing AI features to the next iPhone. And maybe that will be what popularizes it. Because I think at the moment we're in that very early stage where tech companies are buying huge amounts of chips from Nvidia. That's why Nvidia is doing so well. And actually that Robert Armstrong piece makes an interesting point, which is that Nvidia's revenue is largely coming from those handful of big tech companies. And yet it's pricing in way more revenue growth than they are pricing in CapEx spending. So there's a little bit of a mismatch there. It's going to have to find some customers to bridge that gap, right?
And those customers are themselves trying to produce chips which will be able to run all of these large language models, competing directly with NVIDIA.
But the great unknown with AI is that how useful is it actually going to prove to us as everyday citizens, as businesses in other sectors? What are we going to use it for? Is it going to boost productivity and profits? Is it going to result in mass unemployment? These are all things we don't know, but it is kind of priced in to be revolutionary.
I think we can already start to see the limitations when you ask it to do something and it just comes up with a nonsense answer. Because all it's doing is regurgitating statistics of text that it's already seen. So I think from that point of view, it's always going to be limited by that input.
Roman, have you not seen the leaps and bounds improvement in the ability of AI to generate video of Will Smith eating spaghetti? It's incredible. Over the last year, it's gone from that monstrosity with bolognese everywhere to a convincing image.
Yeah, I think things like copying voices, so if you type in a piece of text, it can say it in someone's voice. Computer-generated video, that's incredible. But when it comes to having something which has a deep understanding, I think that's where it's really limited. And it can still be the case that it just produces something which is just clearly not right.
This is your bear talking, Roman, because the models at the moment are the worst they're ever going to be. Like every year they're going to get better and better. This is the worst it'll be.
Yeah, I'm not convinced it's going to improve by that much.
Oh, really? You think we're sort of hitting the limits of what a large language model can do already?
I think it's going to be limited by the input. And, if they throw more hardware at it, maybe they could squeeze a bit more information into them and perhaps make the statistics much better so it comes up with something more plausible. But I think we're already starting to see the edges, if you know what I mean.
So you think the limiting factor is literally the amount of information we have available in the human sphere of knowledge to cram into them? Some people do say that. It's like once you've ingested everything ever written, where are you going to go from there?
Yeah, and I think eventually they could improve the models, of course. But ultimately, I think the rate limiting thing is going to be the data that gets fed into it.
Interesting. Because some people say the limiting factor is going to be power supply. Like the models can scale infinitely, but eventually you'll need like a sun to run them, just a dedicated nuclear reactor for every data center.
I think they'll probably make the models more efficient, and so their power consumption will fall. That's one of the innovations which will probably come around. And I think the other problem is going to be the legal constraints of the data which they can feed into it. We've already seen artists push back on whether they can use their art to teach the models. And I think people will get much more cagey about allowing AI to use data that they've provided.
I hope Robert Armstrong doesn't mind us using the data he provided in the FT. But if you believe what you're saying, it sounds like you think AI is a hype bubble and won't deliver on its promise.
I think it won't deliver on all the promises. I think in terms of the revolution it's going to provide, people will still be required because ultimately people trust other people. They don't trust AI. There are certain things where you just wouldn't trust an AI to do it for you. And here I'm thinking about things where it's literally life-threatening. People talk about AI medicine. So, for example, using an AI to diagnose people or maybe even do the operations if it's a robo-surgeon. But personally, I still think we're a long way off trusting machines to do that.
I think you're right about that. I mean, every time there's a crash from an EV, like if a Tesla just plows into someone when it's on automatic drive mode, the media goes crazy, yet we ignore the fact that people are crashing their cars all the time.
This is it. There's always going to be that kind of distrust of machines. And, you just go back to the 19th century and see saboteurs. They saw mechanization in industry replacing their jobs. And there was huge pushback. And I think we still haven't seen that. We're still in the kind of honeymoon phase, as it were, for AI.
I saw there was some interesting research published, I think it was last week, where it said that self-driving cars are actually safer than those driven by humans, except when it is dusk, dawn, or if the vehicle is turning. I thought, wow, that covers a lot of scenarios right there.
As long as you go in a straight line in daylight, you're fine.
Yeah, with clear roads.
Now, there are some massive fails that have happened recently, which I love because they're just so funny. For example, Bloomberg has an autonomous news bot, and one of its claims was that Berkshire Hathaway stock crashes to zero, ! Which would be really interesting if it had happened, of course.
Yeah, that was a weird one because it was an error in the stock exchange where the published figures showed that it had crashed to zero. And obviously no real writer would publish an article about it going to zero. It's an error. AI doesn't care.
It doesn't check its sources. Interesting.
Warren Buffett, bankrupt. The one I liked was Air Canada, who just lost a court case because their customer service chatbot was chatting to a customer who was trying to fly to, I think it was his grandmother's funeral, and was talking about booking tickets. And the chatbot said, yeah, we'll offer you a bereavement discount. Here you go, half price tickets, blah, blah, blah. He said, great, well, let's go. And then it charged him the full amount. And he sued them, obviously, saying, you offered me this discount. Whereas Air Canada was saying, no, we didn't. Our weird chatbot did. That's nothing to do with us. Obviously, the court said, no. The point of a chatbot is it's chatting on your behalf.
Yeah, this is it. I mean, would you trust a chatbot to represent your company? That's so risky.
I would quite like it if we return to this kind of barter economy where the game is you've got to fool a chatbot into giving you a discount.
My chatbot will fool your chatbot. The one that really shocked me, and as I'm a big fan of McDonald's, this was quite upsetting, is that McDonald's AI ordering system turned out to be ordering thousands of chicken nuggets for some people, or things like ice cream topped with bacon. I mean, who knows? It might have been good, but I doubt it.
I'm not sure that wasn't a real order. Ice cream topped with bacon. That sounds like America in 2024.
But Laura makes really innovative ice creams. She made an amazing Parmesan cheese ice cream and a popcorn ice cream. You would not believe how tasty it was.
Parmesan cheese ice cream sounds very hipster for you guys out in Amersham.
Oh, no, it was so good. So good. It was kind of savoury, umami, and yet sweet. It was just amazing. Her daughter absolutely loved it. And she lives in London and she's got this kind of sophisticated palate. So, yeah.
Forget pension craft, set up an ice cream manufacturer.
Laura's thinking about it.
You just got to squeeze AI into the business pitch and you'll get all the funding you need.
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and the lowest FX fees on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Not ready to invest? Trading 212 has recently launched an attractive flexible cash ISA with interest paid daily. Customers can also benefit from the Trading 212 card, which offers 1.5% cash back on all transactions until October the 1st, 2024. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 account and make a minimum deposit of £1 and use the promo code RAMIN, RAMIN, or the link in the show notes. When investing, your capital is at risk. Past performance doesn't guarantee future results. Other fees may apply. Interest applies on the uninvested cash in your account. Free shares can be fractional. Terms apply.
Okay, so I think we've covered AI, and the judgment of whether it's overvalued, whether it's a bubble, comes down ultimately to whether you believe it's going to deliver on its promise. But that's only a small corner of the market, even if there is concentration there. How are other markets and other assets doing this year?
An interesting one is emerging market stocks. So normally what happens when the Fed raises interest rates quite aggressively is there's some kind of EM crisis. Well, not this time. So they're up 6% year to date. France is in trouble because they've had some kind of geopolitical shock, self-imposed, where Macron decided to call a snap election.
Yeah, that was interesting.
Markets didn't like that at all. And France is down quite considerably as a result of that.
It was interesting because it was doing pretty well this year. Then he called the elections and it lost all of its gains. So it's basically flat since the start of the year.
Which as Brits we liked because it meant our market was larger than the French market. So hurrah for the FTSE 100.
In the land of the blind, the one-eyed Brit is king, basically.
Of course, all it really means, the real story, is that we're both roughly Nvidia-sized, at least for now. But Europe as a whole is up about 4% in dollar terms. One place that really is suffering, I think, is Brazil. That's down about 20% year to date. That's partly the perennial worry about too much spending by the government in Brazil, but also it's very much dominated by Petrobras, where the government's trying to push a bill through Congress that would hand over 5 billion barrels of untapped oil reserves, which currently are owned by the government, to Petrobras in exchange for a greater stake in the company. And markets didn't like that.
It shows the danger of concentration because that one company is such a big part of the Brazilian market.
Yeah, that is one nice example of the concentration risk. And many other markets are more concentrated than the US, for example. And then if we look at fixed income, long duration US Treasuries down about 5% year to date, so nothing like the bond crash in 2022, but still a loss. The belly of the curve, 7 to 10 year Treasuries down about 2%, and then short-term stuff up about 0.3.
It's still not the year for fixed income.
No, I don't think so. And many people talk to me about this, saying, look, I think interest rates are going to go down. Why aren't bonds doing better? I'm thinking about buying them. And the problem is that a lot of it's priced in. So whatever profile of cuts markets expect is already in the price. And it's only surprises above or below that which would move yields.
Is it also the case that, yes, short-term rates might fall when the Fed cuts interest rates, but the long end of the curve, which is looking at growth and inflation, probably isn't going to move around that much?
Yeah, if you can imagine it as a kind of visualization, the long end of the curve is usually pinned by growth expectations, and then the short end is wiggled about by the central bank. So what you end up with is the short end moving down, and then the long end probably won't move too much, I wouldn't have thought.
Especially with the scale of issuance that governments are going to be doing over the next few years. It looks likely that they're going to have to sell a lot of bonds into the market. So that doesn't look great if you're expecting yields to fall. It's a headwind.
Yeah, we're still seeing a fiscal deficit in the United States. So whoever's going to win this election in November, they're probably going to spend a lot of money, whether that's Republican or Democrat. So that means issuance, and markets may not like it. So there could be an accident in the US Treasury market, which would be a shock. And I think that would certainly be a problem for stocks.
The bigger unknown for markets, I guess, is tariffs, where Trump is hinting at a 10% tariff on all imports, regardless of where they come from, which would be a big deal.
Yeah, that could be a drag on the economy. And I think that's not fully priced in if you look at the exuberance we see in the markets at the moment. But of course, if there was a tax cut, that's what gave a bump to markets in 2016.
One thing people are pointing out is how well gold has done this year, up more than 12%, and silver up almost 25% for the year.
Yeah, the fundamental models tell me that those are overpriced. One of the reasons behind that, I think, is central banks buying it. China in particular has been cutting its holdings of treasuries and substituting other currencies. I understand they're buying a lot of Russian oil at the moment.
And a lot of gold.
And a lot of gold. So, yeah, I think that's one of the reasons. People are worried about weaponization of the dollar. So countries which may not be particularly friendly with the US have certainly been getting rid of their dollar reserves. But what is surprising is that given interest rates are quite high, gold has been doing so well. Usually, because it's a wasting asset, it doesn't do so well when rates are high. Maybe this is anticipation of rates being cut later in the year. A really important one is oil, because that's an input cost for many industries. It's particularly worrisome for the UK because we have to pay for energy. We're still very dependent on energy costs. And that's been moving up recently. Since the beginning of 2023, it's kind of been whipsawing between around $70 a barrel up to about 90. But it seems to have kind of recently increased. So if you look at the UK CPI numbers, the most recent print actually showed an increase due to higher transportation costs and household services.
It's another one of the big unknowns, isn't it, for the rest of the year? What happens to the oil price, particularly ahead of the election?
Yeah, if it really does spike, then we could see another inflation shock if it's a really sharp shock. But at the moment, it doesn't seem as if there's going to be a big shock in the Middle East. But of course, you can never say that with any certainty. Things can escalate very quickly.
And it's not really a free market, oil. Like OPEC have a big influence on supply, as do the US. The US has shown it's willing to use its strategic petroleum reserves. And actually, the Biden administration has made a big profit on that. Did you see on that
Yes.
trade? Biden should become an oil trader.
He probably is.
Bought low and sold high. Okay, so just to wrap up, where do we see the opportunities in the global economy here? Or at least, what doesn't look expensive on the face of it?
Well, everyone says the US is expensive, but if you look at small caps, they're still trading at a huge discount to US large caps. So the forward price to earnings multiple for the S&P 600, these are the tiddlers of the US market, that's 13.9 times. You compare it to the large caps, dominated by Nvidia, that's 20.9 times. So that's why I bought some S&P 600 a while back. That still hasn't paid off at all. If anything, it's gone the other way.
Yeah, if you look at any US small cap fund this year, they're flat or have lost a few percentage points. But is that because of rates? Like small companies usually have higher borrowing costs and get punished when rates are higher, and rates haven't fallen as was expected.
Yep, a lot of financials there, a lot of loans made to real estate companies, and that's a worry. And so if the credit quality of those companies is low, then yeah, if interest rates are high, you'd expect that to weigh on the index. But of course, it is going to be coming down. So I think that'll be potentially a catalyst for small caps to finally recover, or at least I'm hoping so.
And what about outside the US? Are there any equity markets around the world which you look at and say, well, maybe that is cheap right now?
Yeah, China looks cheap. And of course, we all know why. And a lot of it is to do with geopolitical tensions. And those could escalate quite quickly. And of course, we've got a trade war, which probably is going to get worse from here, both with the US and with Europe. Maybe not with the UK. We can't afford to upset them. But China's trading at a 9.9 times forward multiple, compared with the US's 21.5. France was looking expensive in Europe, but of course recently that tumble in the French stock market has pushed it down to about 13 times forward earnings. Germany's at 12, I still think that looks cheap, and the UK's at 11.4. Now I do have a UK overweight. I'm not quite brave enough to go overweight China, so I think there could be some upside there. But actually almost any country, except for India, other than the US, is going to be reasonably priced at the moment.
And fixed income, any opportunities there? I saw that your favourite trade has opened up again, where spreads within the Eurozone have widened following the French election announcement.
Yeah, that's always an interesting one, because it's always dicing with this binary outcome, which is fragmentation of the Eurozone, which would be catastrophic, of course, if it were to happen. People may not realise that, and that might make them think it's not such a bad idea. But I always believe that it's not going to happen.
So you always expect the spreads to close again?
Yeah, at least so far. I mean, if there was strong evidence that there was going to be fragmentation, then clearly that would change. But yeah, I'd expect that to tighten. And if you look at credit markets, credit spreads, which are the additional return you get from taking credit risk, certainly in the US, are very tight. So pretty much pricing in no credit problems at all, which I think is a little bit complacent. So I'm not really interested in high yield at this point. If there was an accident, I'm ready. It's in my market crash shopping list. It's been there for a long time now, but I think that could be an interesting opportunity. The way I see it, that spread is kind of like icing on the cake, because the all-in yield at the moment is dominated by risk-free rates. But if you get the additional spread due to the credit risk, that could be interesting.
There's not much sign anywhere that the market is expecting turmoil.
Yeah, those credit funds like HYG, which is the big junk bond ETF, that's flat for the year to date. LQD, which is the investment grade one, is down 2%, so that's due to risk-free rates probably rising rather than credit spreads widening. So yeah, I think at the moment, a lot of complacency, and that's not a market which I think is attractive at the moment. Real estate's an interesting one because that's obviously taken a hit due to higher interest rates and also behavioural shifts away from office space.
Yeah. In the US, I think those big real estate funds are down around 5% for the year.
Yeah, like that monster VNQ fund from Vanguard. So that could be interesting, because if interest rates do start to come down and there hasn't been a shakeout, or at least the default rates are not going to go way above where they are now, then that could be a good buying opportunity. But personally, I'd still wait a bit longer for that to be interesting.
It feels like there isn't much sign of a crisis on the horizon, at least in the fundamentals. So like I said, credit spreads are tight. The VIX index is very low, so the markets aren't expecting a lot of equity volatility in the coming months. Perhaps it would take a big geopolitical shock to change things. There's a characterization from JP Morgan Wealth Management, which described the current state of affairs as a strong economy in a fragile world, which I thought, just as a soundbite, kind of captures where we are right now.
You can probably tell there's always some opportunity in markets, and this is something which we often discuss in Pension Craft. So if you want to learn more and also discuss these investment opportunities, then you can find out more by going to pensioncraft.com.
Okay, today's dumb question of the week is, what isn't priced in to markets? Our standard answer to why something doesn't behave as expected is always that it's priced in. People are expecting it, so when the event happens, nothing happens. But what isn't priced in? Markets aren't omniscient.
I think the characterization of markets as Mr. Market, a human, is a good one by Warren Buffett and, of course, originally from Benjamin Graham, because people are emotional and markets respond in an emotional way to new information. I think this is a little bit veering into psychology. So we talked about narratives earlier, and I think markets are very much prone to narratives. So anything that falls outside that narrative is not going to be priced in. Earnings numbers, clearly, that can be priced in. Expectations about what central banks do can be priced in. But that's why things like geopolitical shocks are so difficult to take into account, because they are unpredictable. It often comes down to the crazy decisions of one person about whether you start a war or start a trade war. So that's almost unpredictable, and markets just can't factor that in.
Do they not factor in a kind of weighted average of probabilities of the war starting?
I think what they actually do is at the very last minute, when it becomes obvious something's a problem, that's when they react. And the feeling seems to be that up to that point, it'll be fine. You saw this with the pandemic. Even after the WHO declared it as a pandemic, markets still didn't react for some time. It had to get really bad before they eventually capitulated.
And then they overreacted in the short term. Like the sell-off was crazy. We were losing 10% a day, right?
Which is always the way. Overreaction when you finally do admit there's a problem, because it's a human trait to overreact in that way.
Like there's no way the value of a company like Apple should lose 40% in 2 or 3 weeks.
Yeah, and things like the treasury market going into freefall, that was a real shocker, particularly for the Fed. They really had to step in and save the day.
So geopolitics, pandemics, these really hard to predict things, like how could a market price it in? If you're trading equities in New York, what do you know about what Kim Jong-un's going to do tomorrow?
But also I think things like central banks, if you look at analysts at central banks, they're all kind of like a monoculture. They all went to pretty much the same universities. They've all got the same background. They're all quite privileged, usually quite wealthy background. So clearly there's going to be groupthink, and they just don't understand some things. And I think populism is one of them. It's hard for these people to understand the psychology of people who are voting for these populist politicians. So I think that's a problem.
I think you're probably right that there's an orthodox view amongst world institutions. And sometimes it gets surprised. Maybe Brexit was one of those examples where people thought it was going to be close, but everyone assumed it's not going to happen because these kind of things don't happen. And then it did.
Yeah, that was a good example.
But is there any way for you to know these things are going to happen and therefore trade them? Do hedge funds make a living off betting on geopolitical events? I doubt it.
I don't think so. I don't know of any. And I think it is difficult to make money out of them.
But are geopolitical events the only things that can surprise markets? There are certainly financial examples, like the financial crisis 2007 was not really foreseen by markets, hence they moved massively once the scale of the problem became apparent.
But there's also a sense that institutional investors are forced to be positive in their outlook by their remit. They have to assume that things will be okay, because if they weren't of that mindset, most of the time they'd be wrong. But of course, bad things do happen and then they get wrong-footed.
The funny thing with some of the economic statistics that get pulled out every month, like retail sales, for example, is that they depend so much on weather, which in the short term is unpredictable, right? Shoppers in Britain didn't go and spend so much money because it rained. And that surprised markets. And the pound moved. How is that a surprise? Come on.
But that's a good example of an exogenous shock where you've got a fundamentally unpredictable thing, which is weather, and it drives prices. And the commodities market is very much driven by these unpredictable factors. If there's a disease in pigs or some kind of fungus affecting crops, that can massively affect prices. And you don't know when that's going to happen.
Is it the case that assets that are more volatile necessarily are trying to deal with more things that are hard to predict and price in?
Yeah, I think that's definitely true. Volatility is the flow of information. And if something's predictable, well, effectively what you're saying is that there's not much flow of information, so the volatility will be low. Whereas if you have something like oil, which is just buffeted by almost every factor, economic factors, is there demand for it? Is GDP going to be strong? Supply issues about war, all of that is very unpredictable. So it's not surprising that it's very volatile.
And the other major thing that isn't priced in is non-public information. There's a huge amount of information about stocks and companies, which is known, but it's just known inside the company, really. Or if it's known by other people, they shouldn't be trading on it.
Yes, it is illegal. So we'd hope that's not priced in.
And that's where you get a big move in the stock price, where some major market moving information is finally released. Ideally to everyone at once through a press release and not through a leak.
But any kind of societal change which is rapid and surprising would also not be priced in. For example, if there was a huge technological breakthrough that would make travel much cheaper. For example, one kind of classic example is superconductivity at room temperature. And this is why I was so excited when there were rumours that that had finally been achieved, because almost at a stroke, it means you can actually transmit power with almost no transmission loss. And that means you can take power from where it's created to where it's needed. So that could completely revolutionise the energy industry. So if that were to happen, I think that could be very market moving.
And it would be interesting because we've often talked about these things that are exogenous as negative factors, but there can be these big surprises to the upside.
Yeah, there can be positive shocks as well as negative shocks. So I think these are the kind of unpredictable things which people probably would not be able to price in correctly.
Thank you for joining us for Many Happy Returns. Do send us your questions, no matter how dumb, at the email address mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Romin Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.